How's it going, guys? Hope you guys are having a good day or night. We are back today looking at the Dividend portfolio. And I'm also going to be looking at a new stock today, and potentially swapping it in for another holding in the portfolio, which I will talk about. Before I do get started, traditional disclaimer that none of this is financial, legal, or tax advice. I'm not a licensed professional. This is all just my 2 cents for entertainment purposes. So, consult a professional, do your own research, and consult a professional before investing. So portfolio is continuing to do rather well. Sitting at $2,061.09. We're kind of continually hitting new highs. That's kind of in part because the market's rallying, but obviously also because I'm continuing to add my $20 each week. But I've now contributed a total of $2,200, and the portfolio is at $20.61, so that means I'm down about $138.91. I have received $88.14 in dividends. On an XIRR calculated basis, I'm down 5.67%, so that's like money weighted, and non-weighted return would be negative 6.31% return currently. So we're coming back, not doing too bad. You guys see the portfolio over here on the left. All the same holdings that I have had. I have just been slowly buying more Visa, trying to fill out that position. I do think that I'm going to sell out of Agree Realty. I'm going to split the money between Visa and Medtronic, which I'm going to talk about in a minute. The main reason I'm doing that, Agree Realty, I don't really see it as a growth play. They have a slightly higher yield than Medtronic, but I want a stock that's going to appreciate and be innovative, but one that's also growing its dividend pretty well, and Medtronic is. Same with Visa. So I think that I'm going to be selling out of that, and I also just think from like an economical standpoint, the retail sector, it's doing fine. Credit card spending is at an all-time high. We did have a good Cyber Monday and Black Friday, but overall spending is down, I believe. Home transactions are down. Just a lot of things that don't look great for the retail sector, and I'm not worried per se, but yeah. Still coming off my cold, so my whispering kind of makes me feel like I'm going to lose my voice. But let's take a look at Medtronic. I've known about this company for a long time. I have owned it a couple times in the past, and it was in my healthcare videos. I made a couple of those, kind of talking about trends that I saw in the healthcare space and a couple of my favorite stocks. I did end up kind of consolidating those stocks down, just because it was too many things to track. But I do think there was some good picks in there, and it's still things that I'm interested in. Obviously not all of them are good fits for a dividend portfolio, but I like Medtronic, and we're going to get into that. So Medtronic, if you're not familiar with it, they are a medical device company, pretty wide array of medical devices, and they'll get into that. They make a lot more implantables than some of the other medical device companies. Think like aortic stents, things like that. Let's see. So maybe I'll go to the little blurb, because they'll probably have a more elegant way of introducing the company than me. Develops and manufactures and sells device-based medical therapies to healthcare systems, physicians, clinicians, patients worldwide. Its cardiovascular portfolio segment offers implantable cardiac pacemakers, cardioverter defibrillators, and cardiac resynchronization therapy devices, cardiac ablation products, insertable cardiac monitor systems, yada yada yada, remote monitoring, patient-centered software, aortic valves, surgical accessories, transcatheter pulmonary valves, coronary intervention products, angioplasty balloons. They have surgical staplers, vessel sealing instruments, wound closure, electrosurgery products, surgical artificial intelligence, and robotic assisted surgery products. That has kind of been a trend. Stryker has a big one as well, and so does Intuitive Surgical. Hernia mechanical devices, mesh implants, gynecology and lung products, and various therapies to treat diseases. Wow, they're going into a lot of detail here. Airway management, ventilation therapies, renal disease, neuroscience products for spinal surgeons, neurosurgeons, neurologists, pain management specialists, anesthesiologists, orthopedic surgeons, urologists, urogynecologists, interventional radiologists, ear, nose, and throat, ENTs. Yeah, they make a crap ton of stuff. They're currently headquartered in Dublin, Ireland. That was kind of a big shift that a lot of companies did a while back. They'll claim it was for labor and a lot of other reasons. There are a lot of tax benefits to being headquartered out of Ireland, and I'm sure that has to contribute. But yeah, so it is a $105 billion company. Very, very big company. Currently paying a dividend about 3.5%. PE going forward of 15.3. God, I can't read. Doing all right for the year, about flat. It's had a strong performance in the past decade, kind of leading up to COVID, and into the beginning of COVID, it did really well, and it's kind of gone downhill since, which is kind of why the yield has gotten up there. And I think that has to do in part with, well, during COVID, I think there was a lot of pauses on a lot of operations, especially elective procedures, and we're starting to see a return on that front now, but I also think they're having some issues with stagnated revenue and stagnated growth, and we'll take a look at that, but I think the value proposition is there, and I like it overall. Just real quick to look at the dividend. They have had a dividend growth of about 7% compound average growth rate for the past 3 years. It's been decreasing a little bit since the past decade, but not bad, especially for a 3.5% yield. If we look at their revenue, we can see it has been a little stagnated lately, which kind of ties into why the stock has been trading flat a little bit. About $31.5 billion in revenue. Earnings per share, pretty, eclectic as well. But on an annualized basis, rather flat and consistent. They have been slightly buying back shares, but nothing real noticeable. And if we look at their debt, so about $90 billion in assets and $39 billion in liabilities, so they're in a pretty good spot debt-wise and margin-wise. It's pretty consistent profitability, mostly in the teens, but I think that's okay. I think the most important thing for them is that they kind of find some new ways to grow. I know there's been a lot of inflationary pressures. We're seeing currency exchange issues, or not issues, but headwinds, probably especially important when a company is not based in the United States. I have their most recent quarter of earnings. This is for fiscal year 2024, quarter 2. They're reporting an $8 billion revenue for the quarter, increase of 5.3%, and that's about 5% organic. GAAP earnings per share of 68 cents. Non-GAAP EPS of $1.25. Looks like they have FDA approval for a couple of their products that are in the R&D pipeline. let's see. Same. Here we go. Revenue and the associated impact from foreign currency translation reported as other. Some business separations. I guess they spun off maybe their renal care solutions and their manufacturing agreements with Cardinal Health. Maybe they were acting as a contract manufacturer or a CMO. The favorable impact from foreign currency translation of $86 million in the remaining segments. Okay, so it's not hurting them that bad. Net income of $909 million, diluted EPS of 68 cents, both representing increases of 113%. Wow. You did see their EPS was pretty erratic. I guess a lot of companies do this, but they have a non-GAAP kind of reconciliation to account for some irregularities that may skew EPS. So they provide a more flatline metric here of $1.25, which is a decrease of 4%. So this is their cardiovascular portfolio. Revenue of $2.9 billion, up 5.9%. 4.8% organic growth. Not going to dive too much into the specifics. Neuroscience portfolio is up 4.7% as well for a revenue of $2.3 billion. MedSurg up 7%, revenue of $2.14 billion. And their diabetes segment up almost 10% with a revenue of $610 million. And they did issue their guidance for the rest of the year. They raised, which is a good sign. So they increased their fiscal year 24 organic revenue growth guidance to 4.75%, up 25 basis points from their original estimates. EPS estimates range of 508 to 516 was raised to 513 to 519. Nothing crazy there, and then I just have their presentation pulled up. To some degree, it is another kind of stable, more blue chip like company. I don't want to say it's like a knock your socks off growth story, but I do find it more attractive than Agree Realty. Here's a breakdown of their revenue by segment. Decent amount of exposure internationally, which is nice. Here you can see the different countries broken out. So actually not that high of a growth in the United States, but Middle East and Africa is growing huge. China, Western Europe, high single digits. South Asia, high teens. Southeast Asia, mid-teens. Sales are down in Eastern Europe. Got some products in the pipeline. 130 product approvals in key geographies in the last 12 months. That can be a little misleading if you're like double counting approvals in different geographies for the same product or different variants of the same product. But that's good nonetheless. Here they're just breaking down even further within the business units. Looks like their structural heart and aortic business unit was the biggest grower for this segment, up 8.2% year over year. In their neuroscience business, their cranial spinal technologies business was the biggest, 7% year over year growth. And MedSurg was their surgical and endoscopy business, up 8.5% year-over-year growth. Diabetes had pretty solid growth as well, mostly in non-U.S. countries. It looks like diabetes is becoming a big issue worldwide, which is interesting to see. Even in some developing countries, it's become a big issue. Dividend and share repurchase, target minimum of 50% of free cash flow returned to shareholders annually, prioritizing dividends. $4 billion net share repurchases, and dividends 86% of free cash flow, 46 years of dividend increases. It is a dividend aristocrat. Sustainability, who cares? Yeah, let me know what you guys think. I have been trying to find some things that would interest me further than what's in the portfolio already, because like I mentioned before, I did have some hesitations around Agree Realty, and I think Visa and Medtronic are definitely way more exciting prospective investments than Agree Realty. Not that it's been a bad stock, but I do like it, and I think that I'll add Medtronic in when I get the chance. Let me know what you guys think. Certainly things to like and things not to like with Medtronic, but always curious to hear your guys' opinions, so drop a comment if you have any thoughts, and I'll see you next time.